and welcome to this new edition of News Insurances Weekly. We are Monday, October the 10th, 2011. Here are the headlines. The FSA decides to go ahead with the Solvency II implementations in January 2013. Fitch Ratings held its first insurance roadshow in Paris this week, where the challenges of the European and American insurance sectors were discussed. The final deadline for Solvency II implementation is now January 2014. We could believe this to be welcomed by the industry as it leaves more time for preparations. Yet new results from a Marketforce survey show that some companies are ready to incur additional costs for the extended delay, leaving them to feel penalized for being on schedule. So the FSA has decided to enforce the Solvency II rules by January 2013. And this is welcomed by a majority of the insurance sector in the UK. Fitch Ratings held its first insurance roadshow in Paris this week, where the challenges that the European and the US insurance market face were discussed. We have met with Chris Waterman, Managing Director at Fitch Ratings, and asked them about the risks the European market is facing. Let's listen to Chris Waterman.
We see the biggest threat facing European insurance companies as their exposure to European sovereign risk. Insurers are large holders of corporate debt, sovereign debt and equity relating to peripheral Eurozone countries. Our view in terms of ratings is that because the holding across Europe in Greek, Portuguese and Irish investments is relatively small, that a default of those countries would unlikely impact our ratings significantly. However, European insurance companies have much larger exposures to Italy and Spain, both directly and indirectly through their investment in European banks, where those banks in turn have shareholdings and debt holdings in peripheral Eurozone countries. Should we see Greece and Italy default, which we view as unlikely because their sovereign ratings are very high, but if they were to, then we would expect a material impact on European insurance companies' solvency and potential negative rating actions as a result. And those negative rating actions could be widespread and in some cases could even be multi-notch. I would stress that we view a default of Italy and Spain as highly unlikely given their AA ratings at the moment. But that is an extreme scenario.
That is all for this week's edition. Thank you very much for your attention. Please tune in to newsinsurances.co.uk for this week's exclusive video interview. Goodbye.